Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JS Global Lifestyle Company Limited annual report. JS Global Lifestyle Company Limited offers a diverse range of businesses and services across various segments. At the core of their operations are small kitchen electrical appliances, including cooking and food preparation products such as rice cookers, pressure cookers, induction cookers, air fryers, blenders, soy milk makers, and food processors. In addition to these products, the company also provides cleaning appliances like upright vacuums, cordless and corded stick vacuums, and other floor care products. They also offer a range of small household appliances including water purifiers, water heaters, thermos, and hair dryers. Beyond product sales, JS Global Lifestyle Company Limited offers various services such as enterprise management, advertising and consultancy, marketing, supply chain management, administrative and procurement and office support services. The company is also involved in housing leasing, research and development of water purification equipment, IT development, sale and maintenance of home appliance products, retail of home appliance products, and e-commerce business. The company operates under the Shark, Ninja, and Joyoung brand names and has a presence in mainland China, Japan, Australia, New Zealand, and internationally. With its diverse range of products and services, JS Global Lifestyle Company Limited is well-positioned to cater to the needs of consumers across various markets. JS Global Lifestyle Company Limited market capitalization of $6 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that JS Global Lifestyle Company Limited holds a significant advantage in their industry. JS Global Lifestyle Company Limited trades at a higher price-to-book ratio of 1.45 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of key market trends and product launches. On the growth side, innovation-led products have been a major contributor to revenue expansion across various categories, including core product lines such as Slushie, FlexBreeze, and Luxe Café Premier. The launch of innovative products in Japan and South Korea has also driven growth, particularly with the introduction of new brands like Ninja Blast Max and Silent IQ Blender. In addition, e-commerce momentum in Singapore and continued market-building efforts in Southeast Asia have contributed to revenue growth. Stable revenue growth in the Joyoung segment has been driven by sales improvements in soy milk makers and food preparation appliances. Furthermore, innovation-led product launches in key APAC markets, geographic expansion into emerging markets, and strong performance of lightweight cordless vacuums, smart blenders, and ice cream makers have all contributed to revenue growth. On the decline side, a lighter innovation cycle in the personal care category due to adjusted new product launches following regulatory changes has led to revenue decline. Weak demand for rice cookers and air fryers in the Joyoung brand has also contributed to revenue decline. However, it is worth noting that there may be other factors contributing to revenue decline, such as increased trade receivables and turnover days, although direct information on this is limited. The net income of the company underwent significant fluctuations over the years. Initially, it increased by $77 million in 2025 and $127 million in 2024. However, this trend was short-lived, as the net income decreased by a staggering 313.6% to a net loss of approximately $18.8 million on page 27. The company's fortunes improved slightly, with an increase of approximately 4.6% to US $533.9 million on page 33. Unfortunately, the group did not achieve profitability on page 53. The profit margins also experienced changes in different segments. On page 27, the gross profit margin increased by 0.2 percentage point to 32.2%, while the adjusted EBITDA margin was not applicable for comparison. The net profit margin implied an increase of 338%. However, on page 34, the Joyoung segment saw a decrease in its profit margins from 29.4% to 28.9%, and the Shark Ninja APAC segment experienced a decline from 47.6% to 42.4%. The reasons behind these changes are not entirely clear, but some factors were mentioned. The company's refining of their approach to accelerate growth and enhance capital efficiency on page 27 might have contributed to the initial increase in net income. However, higher freight costs and competitive headwinds affected the Shark Ninja APAC segment on page 34. Additionally, the launch of new categories, expansion to new markets, effective supply chain management, hedging, enhanced supply chain collaboration, and product mix upgrades on page 48 might have had a positive impact on the company's net income. The strategic investments in market expansion and team building on page 53 could also be a contributing factor to the fluctuations in net income and profit margins. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the provided information, one of the key indicators of this success is the generation of positive operating cash flow. This means that the company is able to produce more cash than it consumes, allowing it to invest in growth initiatives, pay off debts, and reward shareholders. A review of page 42 and page 44 confirms this trend, providing further evidence of the company's financial health. The data suggests that the company has been able to manage its expenses effectively, while also increasing revenue, resulting in a positive operating cash flow. This is a crucial milestone for any business, as it indicates that the company is on solid ground and well-positioned for future growth and success. The company's debt level and interest expenses have undergone significant changes between 2024 and 2025. In terms of total debt level, the company has seen a modest increase of 9.6% from $1,496,810 in 2024 to $1,636,230 in 2025. This indicates that while the debt level is rising, it is not at an alarming rate. However, interest expenses have increased more substantially, with total finance costs rising by 27.3% from $2.2 million in 2024 to $2.8 million in 2025. This increase can be attributed to higher interest on bank loans and lease liabilities, which have grown by 100% and 60%, respectively. The performance of various segments and regions in the market has been a mixed bag. In terms of innovation, Joyoung stands out as it is at the forefront of several new product categories. This has contributed to its strong revenue growth of 1.1% year-on-year and a significant market share of 62.2%. On the other hand, Shark Ninja's APAC segment has performed exceptionally well, with a remarkable revenue growth of plus 58.1% and an increase in market share to 32.1%. However, not all segments have fared as well. The Shark Ninja US segment has struggled, experiencing a decline in revenue of minus 3.4%. This poor performance is a cause for concern and may require attention from the company to turn things around. Overall, while some regions are thriving, others need improvement to stay competitive in the market. Management is optimistic about the company's long-term prospects, with a focus on achieving sustainable growth through strategic investments and innovative strategies. In the short term, however, profitability is not expected until 2025. To drive growth, management plans to prioritize market expansion, localized product development, and team building. This will involve advancing instant retail through various channels, strengthening targeted product development and content-driven marketing initiatives, and increasing investments in user research and data analytics. In the long term, the company aims to achieve sustainable growth by developing localized products, expanding sales networks, leveraging emerging media, and maximizing synergies between Joyoung and Shark Ninja APAC. Management also emphasizes the importance of meeting consumer needs, winning in core categories, and identifying opportunities for expansion. The company's strategy involves launching new categories in the Asia-Pacific market, expanding to new markets in the region, and focusing on key areas such as instant retail, product development, and marketing initiatives. Overall, management is committed to driving growth through strategic investments and innovative strategies that meet consumer needs and expand the company's presence in the Asia-Pacific market. The company's financial activities for the year 2024 have been reviewed. One notable aspect is that the company did not pay any dividends to its shareholders during this period. This decision may be attributed to various factors, including a focus on reinvesting profits or maintaining liquidity. In addition to dividend payments, the company has also chosen not to engage in share buybacks for 2024. This means that no shares were repurchased from the market, allowing existing shareholders to maintain their proportional ownership of the company. Concerns about inventory buildup and supply chain disruption are evident in the recent data. One of the primary concerns is the significant increase in raw materials inventory, which rose by $3,200 and $3,000 from 2024 to 2025. This substantial buildup could lead to storage costs, reduced efficiency, and potential losses if not managed properly. Furthermore, there are also signs of supply chain disruption. The data shows a notable increase in warehousing and transportation expenses, rising by $4.9 million, 14.8%, from 2024 to 2025. Additionally, the volatility in raw material markets is identified as a concern for potential supply chain disruptions. These issues highlight the need for companies to reassess their inventory management strategies and supply chain resilience to mitigate these risks. That concludes the financial summary for JS Global Lifestyle Company Limited. Feel free to comment below, and I will be happy to answer them when possible.